Good evening. I'm John Batchelor. This is The John Batchelor Show. Larry Kudlow of CNBC and Kudlow Radio joins me, and so does James Pethokoukis of the American Enterprise Institute, and we're going to address the American economy, the global economy, and there are good things to look for. For example, that George Washington that you enjoy, the dollar bill. There's good news there. I want to mention that later on this evening, I will speak much of the bad news, especially the tragedy of the death of the young man who was murdered by ISIS. Another provocative video. I urge no one to look at it. But in any event, what we can expect here in this war fighting in the Middle East is the fog of war. Make no quick presumptions about what's going on, about what we see. There are things to hear from our leadership and from the European leadership, but in any event, these are difficult days because of the skill set of our adversaries and social media. We in America live on social media. We trust the transparency. The enemy knows this. They know how to use what is called agitprop and to send into our homes frightening images that are meant to intimidate us. My experience, my reading of American history is we're intimidated for about 30 seconds. So we begin tonight with positive news about the American economy and this great recovery. But there is a mystery here. Larry, a very good evening to you. Do I say correctly that there is positive news about the economy?
Well, yeah, we had a blowout ISM manufacturing number today, real blowout. And we had a pretty good durable goods report. It looks like business investment may be coming along for the first time. It's a little early. I'm not sure yet, but we're seeing some evidence of that. The trouble is we don't see it on the consumer side, and that's because wages are so slow, 2%. So we're not seeing much consumer spending. In fact, in the income and spending numbers, consumer spending actually fell in July. But I would say on the whole, certainly you're in the 2.5% growth zone, and it may be slightly better.
Jimmy Pethokoukis joins us from the American Enterprise Institute. And James, you published a blog earlier in the month that attracted me because it was filled with this hand, that hand, slow growth expansionism. We're going to have to come up with new modifiers there has to be a magical word. So there's a recovery. It's 5 years old, and the recovery leads us to 2% and celebrating that, not less than 2%. But also we're told it now takes a long time for people to hire a new worker. We're all these exceptions. So does this mean right now that we're in a predictable zone? Have we seen this before, and can we count on it to continue? Good evening, James.
Good evening. I don't think we have seen this before. I think there is some very deep, disturbing. I realize this is the optimistic segment, but I think there is some very disturbing trends inside the American economy that make me think that while we may have some acceleration here, if business investment was the way it has been in previous recoveries, we would be growing over 3% instead of 2%. But I think there's some very disturbing trends with the number of new companies starting up, with the amount of churn in the labor market. I think we see a lot less dynamism in the economy, which leads me to believe that right now we cannot grow as fast as we used to. Can we grow faster than this? Gee, I sure hope so. But what we have traditionally, at least since World War II, I'm very skeptical whether we can do that over a long period of time.
Jimmy, I'm going to get to the optimism in a second, but the startup number is very important. Talk to listeners about the startup problem.
Well, we've seen not just a sort of a longer-term decline in the number of new companies, but in particular, we've seen a decline in the kinds of companies that become your very high-growth, fast-growing, job-creating companies. And that's worrisome, well, for three reasons. One, they create a lot of the net new jobs in the country. Two, they create a lot of the new products and services, a lot of the innovation. And three, they also push the established incumbent companies to become more efficient and more innovative. Without that spark, which is really the spark that makes our economy more dynamic than any other economy in the world, you're dealing with a far more stagnant economy, and that is really my huge concern. And that's where we are. And there were a bunch of studies that came out. The Fed conference in Jackson Hole would seem to support that. J.P. Morgan just came out with a report today, very worried that we're in what they called economic calcification. That doesn't sound good to me. That sounds worse than stagnation, calcification. That's worse sclerotic.
That's awesome. Startups. Actually, it's funny. People say small businesses create most of the new jobs. Actually, it's really startups that create most of the new jobs, but they're scored as small businesses. I think some people miss that. Okay, I don't disagree with you on the long run unless we change taxes, regulations, education, health care, for example. I think we're stifling.
Those are policies you're talking about, Larry.
Right.
Therefore, they can be changed.
If we have a change in policies, really across the board, then I think the outlook is not as difficult as Jimmy's suggesting. But if we don't change the policies, then we're going to be stuck in this 2 to 3% zone. But I will say this current expansion, as weak and tepid as it has been, I still think will go on for several more years. And I'm going to put you with two very simple indicators that I like to use. Number one, in the Treasury bond market, the so-called yield curve, long-term rates remain a couple of 100 basis points above short-term rates. And I don't expect that to change, frankly, for several years. And we've never had a recession that wasn't preceded by an inversion where short rates were higher than long rates. In other words, the Fed's going to stay fairly accommodative. Secondly is profits. Profits come out late, but they're really a leading indicator of the economy. And actually, after a few slumpy quarters, the third quarter of last year and the fourth quarter of last year, and kind of the first quarter of this year, but profits have done very well in the second quarter, and the early reports are good. So if profits keep rising, and the yield curve is positive, I don't see a recession. I would go out 3 years, to be honest with you.
I actually agree with Larry that with rates low, with a Fed still going to be very easy. That's the recipe for a longer expansion. But I'm still worried that we're not going to have some clunker quarters. We had a bad first quarter because it was too snowy. The second quarter was weaker than expected. The third quarter was weaker than expected because it was too cool. Then we didn't spend enough on air conditioning. So I'm really worried that when the economy is this slow, and I think history backs me up, when you have very slow growth, sort of any little thing that goes wrong, it can really have a bad quarter, which then leads me to worry about that we'll have a bad 2 quarters. But as far as like that macro environment Larry just outlined, that's very positive.
Another thing that I like, just to throw it in here, again, I'm still worried about the long run because I think the policies are absolutely wrong direction. But we really don't have any inflation to speak of, and my friend Jim Pethokoukis has been writing about this. I wrote, Jimmy, 2 years ago, my own mea culpa. I said, you know what? The inflation threat never happened from QE2 anyway, and I still don't see it. And the bond market expectations of inflation, John, are very low. They've never been higher than 2%.
I've stopped asking about it, Larry. You've told me not to ask. Yes.
It's just that there's just nothing going on there. The other thing that's of great interest to me, as you pointed out earlier, the dollar is rising.
Right.
And that holds the lid on commodity prices. In fact, crude oil prices are falling. Despite all of the havoc and unrest in the Ukraine and the Middle East, the fact is crude oil prices are falling. And the other thing is the gasoline prices at the pump are falling. I want to qualify that, but let me just say they're down around $3.40. And that's the lowest we've had in a couple of years, and we didn't get the explosion in gasoline prices. Having said that, though, John, I want to make this point. For much of the 1990s, which was a booming year, gasoline prices were about $1.25. Okay, so we have a long way to go there, and I believe that King Dollar, as I like to call it, should appreciate. Of course, if we slashed corporate tax rates, and then the Fed normalizes short-term interest rates, we'd have a very strong dollar and a very strong recovery and a very low inflation rate. But Jimmy tells me that those supply-side policies aren't going to happen.
We're going to talk about the dollar rally when we come back, and I want to start with, Jimmy, one stat you throw up in your piece. This is from Fed researchers. A 70% chance of recession within a year after the annual real GDP growth falls below 2%. I want to ask if we're in that danger zone. Larry Kudlow of CNBC and Kudlow Radio on the Weekend, James Pethokoukis of the American Enterprise Institute. I'm John Batchelor.